Well, welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is episode 142 for the VideoCast, 132 for the podcast for the week ending July 7th, 2022. But this is going to be unlike anything we've ever done. We have a special guest, and that's Philip Vassiliou from Legatum Group, and they're going to be explaining to us a little bit how over decades they've generated outsized returns, so much so the brothers Christopher Chandler and Richard Chandler in a period of 20 years turned $10 million of family money into $5 billion. And if you can't relate to that, let's just put it in simple terms. That would be like turning $100,000, which many people can relate to, into $50 million over 20 years. So it's the philosophy that's key here. For those of you who don't know me, I know we're going to have a lot of new viewers for this episode. I'm Tom Hayes. I'm the chairman and managing member of Great Hill Capital, which runs a long-short equity strategy for accredited investors and qualified institutions. I also run the site hedgefundtips.com, where we publish our weekly research, outlook on the stock market, and the VideoCast and podcast. So without further ado, our special guest, Philip, we'd love to hear a little bit about your background. I know that you started at Goldman Sachs, both in London and New York City. And then you went to the Dubai Development Investment Authority, quite an extensive background. And then you got hooked up with Christopher Chandler. So without further ado, please tell us a little bit about yourself.
Tom, I'm so grateful for the opportunity and the generous introduction. That's really kind of you, and to be on your show and share a little bit about our story is great. So yeah, in terms of my background, I'm half Greek, half Swiss, actually, and born and raised here in the UK, where I'm speaking to you from. Ended up going to university in Boston, and then after Boston, ended up going to New York and working for Goldman. Before going to London and working for Goldman there for another year. And then kind of I had itchy feet, I would say, as a 25-year-old, as a naive 25, 26-year-old back then, and just decided to move to Dubai. Just wanted to live in an emerging market, wanted to be somewhere entrepreneurial, wanted to be somewhere where, just opportunities, I think, look different. And so without a job, I left Goldman. And, funny little anecdote for you, but, this was 2003. And when I went into my partner at Goldman, who I will not name, and I said, I'm leaving and going to Dubai, they asked me what I was going to be doing in Saudi Arabia. So it was, at that time, it was kind of a contrarian thing to do. Moved to Dubai in 2003, worked for the Dubai Development Investment Authority, helping them attract foreign investors into Dubai to help finance some of the infrastructure that they were developing back in 2003, as I said. And after about a year of working there, I got a call from my boss at the time, and he said, we've got these two brothers coming in from New Zealand, and we don't know what they're coming in to talk about, but we'd love you to take that meeting, because at the time I was one of the only kind of non-local Emiratis working for the government at the time. So sure enough, I took the meeting, and it ended up being pretty much a day of just a wonderful conversation with Richard and Christopher in the back of my car in Dubai, kind of driving around Dubai, talking about the different infrastructure projects that were being developed at the time. And through that conversation, I started to hear a little bit about what their investment history was, and got totally captivated. And went back, did a bit of research, and at that time, and this is pre the Institutional Investor article that was written in 2006, which I believe you've shared with some of your viewers, but very little was known about Richard and Christopher. So after digging a little bit, I kind of reached out and said, listen, if you're thinking about moving your business from Monaco to Dubai, I'd love to work with you. Your investment philosophy sounds super interesting. And so the rest is history. It's 2004, started working with both the brothers as they moved, essentially their family office to Dubai. It was called Sovereign Asset Management, and worked with both brothers until essentially starting Legatum with Christopher as our founder, myself, Mark Stolson, and Alan McCormick today as partners. So yeah, sorry for the long introduction, but hopefully that provides a bit of context.
Well, it certainly does. And what it really, what I honed in on with what you said, Philip, is the fact that you are a contrarian by nature. You are willing to take risks. If you talk to someone who worked at Goldman Sachs in New York City and said, hey, why don't you move to Dubai and just see what happens and go be entrepreneurial and take a swing, very few people would make that bet. And what you saw was the contrarian opportunity that no one else was looking at. And through serendipity, you met the Chandler Brothers, and the rest is history. Just to put this whole conversation in context, I want to read off some details here. The Chandler Brothers, they turned the 10 million into 5 billion over 20 years. That's a 36% compound annual growth rate. That compares to Warren Buffett, who did 19% compound annual growth rate over 50 years. Seth Klarman did 20% over 34 years. Peter Lynch did 29% over 13 years. George Soros and Stan Druckenmiller about 30% for 30 years. So what would you attribute to the ability to outperform consistently over time? I know number one is that they had permanent capital. They didn't have to answer to outside investors, which enables them to bear a little bit more volatility. But I'd rather hear from you versus kind of filling in the gaps on my own.
Yeah, I mean, obviously you've mentioned some incredible investors who I know, they look up to and I indeed look up to and have learned from. So it's quite humbling to be in that company. But it's an amazing track record. It's an amazing story of two young guys from New Zealand, and essentially kind of leaving New Zealand to start this incredible investment odyssey that started in Hong Kong and went all around the globe. And as you said, just investing their own capital. And as I think about some of the secrets to investing that capital and kind of what led to those types of returns, as you said, huge advantage, obviously, having proprietary capital. As you probably know better than I do, part of the challenge of this business is not just generating investment returns, but it's raising capital, it's managing a business, it's dealing with regulators, it's dealing with all the noise that comes over and above just the simple day job. And so I would say proprietary capital, as you said, huge advantage. I would say second, just their belief in not taking leverage was massive, and clearly, making very, very concentrated bets, which was, the third hallmark of their investment style. Typically throughout their investment history, they had as few as 2 positions in their portfolio, was perhaps as many as 10. And obviously, when you're taking that level of concentration in your portfolio, no matter how good you are as an investor, sometimes things don't go your way, or at least not in the short term. And so just not taking leverage, and the real benefit that comes from simply just doing nothing and not having a margin call and not having to essentially be a forced seller at precisely the worst time, is massive. You touched on the contrarian elements of their history, and that was a big part of it. It was just being willing to go places that other investors weren't. And so that was a time, obviously, you had tremendous growth and development in emerging markets, and there were still many markets that essentially hadn't had any foreign investors. So, amongst other markets, the brothers were the first foreign investors in Brazil. And so showed up in Brazil and essentially, had to learn how to even access the equity capital markets then. And so being willing to simply be contrarian and go where other investors weren't was a huge competitive advantage. And I would say the last 2 things is low turnover. And so again, just this focus on the long term. Buffett obviously talks about the 10 clips of the bus ticket, and just maintaining a concentrated position and allowing that investment thesis to really play out over years, not as quarters. I think there's this challenge of remaining focused on the actual business that you're investing in, not the movements in the markets. And I think that's a huge competitive advantage that probably stems from their own backgrounds just as business owners and entrepreneurs. And instead of actually approaching investing as trading or as buying a stock, they were, purists in terms of their belief in being, fractional owners of a business and thinking like business owners and thinking like entrepreneurs. So I guess when you take all of those things together, I think it's a pretty unique, but very simple investment philosophy that, as you said, generated some pretty extraordinary returns.
Yeah. So two takeaways from that. Number one was high concentration between 2 to 10 positions at any one time, and avoiding the three killers that Warren Buffett has outlined in one of his annual letters, which is leverage, liquor, and ladies. So we certainly know they avoided leverage. The other side, I'm sure they did a decent job as well. But so keeping off of leverage, being able to deal with the short-term volatility, and concentration of bets. Those are three things that when you talk to the 25-year-olds with the clipboards that are running around for the institutions, they want to know your Sharpe ratio. They want to know all these things that go contrary to actually generating outsized returns in the long term. And I think, just to kind of take a pivot, many people can reference the article that you talked about, The Secrets of Sovereign, which is on the institutionalinvestor.com website. It was written, I believe, in March of 2006. Can you speak to a little bit about some investments since 2006 that we haven't heard about, maybe a couple of the big successes, and the ones that I'm kind of most interested in, and I talk to my viewers a lot about, is the good news is when you buy a stock that's down 80 to 90%, and you know what you own and you know the quality of the business, and you've determined that it's a temporary impairment versus a permanent impairment, usually due to some type of exogenous event. The good news is you have a high chance of making a multi-bagger, 5x, 10x. The bad news is a stock that's down 80 or 90% can go down another 80 or 90% before you have your multi-bagger. So talk to us a little bit about your experience with short-term volatility and some of the recent investments you've been in the last decade or so.
Yeah, that's a great question. I mean, let me perhaps touch on the principle and how we deal with, short-term volatility. And again, it's adopting many of the principles that came from, Richard and Christopher's experience from the sovereign days. But it was essentially kind of staying away from the noise, thinking like business owners, being away from the crowd, and doing things differently. And so, a couple of things, and again, we haven't got this all right, and we've had our own, we'll probably touch on some mistakes a little later in the interview. But we've obviously had our challenges and had to kind of learn the things that work for us. And so a couple of the things that we changed, a number of years ago now, for example, is just getting rid of all the Bloomberg terminals. And as you probably know, that's our language to kind of communicate. That's our language of getting information. That's our language of kind of staying on top of the market. But I think what we realized is that creates so much noise that's totally the opposite of what we're trying to achieve in terms of how we're trying to think, that it's just simply not helpful. The other really helpful thing about Dubai for the first essentially kind of 15 years of our history there was the fact that Friday wasn't a working day. And I think the temptation would have been to, even though we're based in Dubai, we've got to work, Western hours, because that's when markets open. That's when markets are open. And we found just the mere discipline of having a day when the markets are open and not being in the office. So taking Friday where you're not in front of any news, you're not focused on any earnings announcement, you're not focused on economic releases. And then conversely, having Sunday, which was a working day in the office, and Sunday being a day which is wonderful because no brokers call you. There's no markets that are open. There's no news. There's no economic releases. And so it's actually a day to read, and it's a day to think, and it's a day to reflect. And so I think when we're thinking about how to deal with short-term volatility, it's trying to kind of preserve some of those things that actually keep us away from the noise, and allow us just to control our emotions, which, as you know, are just such an important part of investing. You learn how to do the science in business school, but nobody really teaches you how to do the art part of it, and the psychology and being able to control emotions. Like you said, if you're invested in a business that's 50% down and it goes down 80% from there, what do you do? And how do you control those emotions? And yeah, we've had a few of those. But before I touch on those, you asked about a couple of successes, and there really been probably a few that I'd probably highlight. One is an investment we made back in 2016 in the National Stock Exchange of India, and so that's a little bit different because it's private, but it's the size of a public company. It's relatively liquid, so it can trade in the private markets, but It's based on the simple big idea of, equity ownership in India, the growth of, the middle class consumer, and essentially an equity culture that, is going to go from 5% of financial savings to, whether that's 10 or 15, like you'd have in other developing markets to, 30% in developing markets. Just a simple big idea. Exchanges are wonderful businesses, super high margins, virtual monopolies. And so it's kind of one of those businesses that Buffett says best time to sell is never. It's hopefully one of those you stick in the drawer and just let the investment work for you and compound over time. And so that's been a big part of the portfolio since 2016. And then maybe the other example I'd highlight, and maybe it's topical for,